Welcome back to the deep dive. I want you to just take a moment and think about your day so far,
Right.
right from the start.
Okay.
Maybe it began with coffee, that amazing smell filling the kitchen,
Hmm.
or perhaps a specific soap in the shower, or maybe some perfume or aftershave.
Sure, the daily routine.
Exactly. And later, maybe you grab some chips, with that really distinct flavor you love,
Mm-hmm.
or use a laundry detergent that just smells like clean to you.
Right. Familiar things.
What ties all these everyday things together? Well, it's also in the invisible world of flavors and fragrances. They shape these experiences subtly, but really profoundly.
It's true. They're not just little extras. They're often the very core of why we choose one product over another. They influence our mood, our choices, even memories.
Yeah, absolutely. There are these hidden components orchestrating our sensory world. We barely even notice usually.
Silent architects, you could say, of consumer preference. Unsung heroes behind brand loyalty. Without them, a lot of stuff would just be bland.
And today, we're pulling back the curtain on one of the global giants behind all this. Takasago International Corporation. It's this really fascinating century-old Japanese company.
Right at the heart of this whole global sense-making industry.
We're diving deep into a recent analysis that shows Takasago is at this really critical crossroads. It's quite dramatic, actually.
Yeah, on one side, they just hit record-breaking net sales. Fiscal year ending March 2024. Sounds great, right?
Fantastic, you'd think.
But, and here's the twist, their operating profits simultaneously just collapsed dramatically. It's a real head-scratcher.
And that's the mystery, isn't it? How can a company hit almost $200 billion in sales, $195.9 billion, to be huge numbers,
Massive.
yet at the same time see its operating profit just plummet by over 60%? A staggering 61.1% drop. What is going on there?
Is it just a blip? Or, something deeper?
That's the core tension we want to unpack today. We'll look at what it means, why it happened, and what Takasago's really ambitious plan for the future looks like, to try and fix this.
And this story, it really offers some crucial insights, even if you've never heard the name Takasago before.
Right.
Because the products you interact with every single day, your food, your soap, your cleaners, their sensory appeal often comes from companies exactly like this.
It's a peek behind the curtain, isn't it?
Totally. Understanding their story gives you insight into the global consumer goods supply chain, the challenges of innovation, and what it takes for a big company to pivot when things get tough.
So if you're ready to explore these unseen forces shaping your world, let's get into it. Okay, so Takasago. Their story starts way back in 1920. That's over 100 years ago now.
Quite a legacy.
Yeah, they started small, but they've really evolved into this global player in flavors and fragrances, or F&F. They're in 28 countries and regions now.
And what's key to understand, I think, is that they are fundamentally a B2B company, business to business.
Right. You don't buy Takasago Cola off the shelf.
Exactly. They create these highly customized ingredients, that specific flavor, that unique scent for other companies. Big names in food, beverages, personal care, you name it. Think Unilever, P&G, companies like that.
So they're essential, but hidden. Like you might be tasting or smelling something they made right now and have absolutely no idea.
Precisely. And this B2B model, it creates what the analysis calls really sticky customer relationships.
Sticky? How so?
Well, think about a big drinks company. They don't just pick generic orange flavor. They work with Takasago for ages, maybe years, to perfect their specific orange taste, the one that defines their brand.
Okay, yeah, I get that.
Once that flavor is locked in, built into the brand, into consumer expectations, into the entire global supply chain, switching suppliers is a nightmare.
Ah, right. You'd have to reformulate, retest.
Maybe it wouldn't taste exactly the same.
Disaster for a big brand.
Huge risk. Massive cost. That's the stickiness. High switching costs. It makes Takasago really embedded, really integral to their clients' operations. Hard to replace.
Okay, so that's a strong foundation. But their business isn't just one thing, is it? It's split into four main pillars.
That's right. 4 key areas. Let's start with the biggest one, flavors.
Okay.
In FY 2024, flavors brought in $109.2 billion. That's over half their total sales, 55.7%. And it showed decent resilience, sales up 3.4% year over year.
And what's driving that?
Mostly beverages, actually, both in Japan and across Asia. So, that new energy drink you tried, or maybe your favorite yogurt, even savory snacks, good chance Takasago's flavor chemists had a hand in it.
Okay, makes sense.
Pillar number 2.
That's fragrances, also a huge part of their business and a real growth engine lately. This segment hit $62.7 billion in sales. That's 32% of the total.
And growing faster than flavors.
Yeah, impressive growth, up 11.2%. This was really boosted by strong demand for cosmetics, fine fragrances, perfumes, colognes, and also home care products. Think cleaners, air fresheners, especially strong in Asian markets like Singapore and Indonesia.
So shampoo, cleaner, maybe even that fancy perfume, Takasago could be behind the scent. Very likely, they're crafting those olfactory experiences.
Got it. What's the third pillar?
Number 3 is aroma ingredients. Now, this is interesting because it's about the foundational materials, the actual building blocks for flavors and fragrances.
Like the raw chemicals.
Sort of, yeah. Things like menthol, for that cooling effect, or synthetic musks that give perfumes depth and staying power. They make these both for their own internal use in their flavor and fragrance creations, and they also sell them externally to other manufacturers.
And how's that segment doing?
Pretty well, actually. Sales grew 9.1% to $13.0 billion. And what's notable is that this growth happened even though menthol products were apparently a bit stagnant.
So something else must be driving it.
Exactly. It suggests real strength in their more specialized, high-value aroma chemicals. Things that are maybe harder to make, command better prices, show some technological edge there.
Okay, that leads nicely into the fourth pillar, fine chemicals. This is where it gets really interesting technologically, right? Because of the Nobel Prize connection.
Absolutely. This is where Takasago leverages their deep expertise in something called asymmetric synthesis technology. It's a highly advanced field.
And their board member, Dr. Ryoji Nuyori, won a Nobel Prize for work in this area back in 2001. Can you, explain asymmetric synthesis simply?
Let me try. Okay, imagine molecules can be left-handed or right-handed mirror images called enantiomers. Sometimes only the left-handed version works as a drug, and the right-handed one might be inactive or even harmful.
Okay.
Asymmetric synthesis is about creating chemical reactions that selectively produce only the desired handedness, just the left glove, not the right one. It gives incredible precision and purity.
Wow. Okay, so that's critical for things like pharmaceuticals.
Critically important, and also for high-purity electronic materials, catalysts. Stuff where the exact molecular shape and purity matter immensely. It's a real niche, high-tech capability.
But here's the strange part, the divergence you mentioned. While flavors and fragrances grew,
Fine chemicals actually saw a significant sales decline, down 15.8% in FY 2024, bringing in only $9.7 billion.
that's quite a drop. So the Nobel-winning tech segment is shrinking.
It's a stark contrast, isn't it? Consumer-facing stuff doing well, especially in Asia. High-tech, industrial-facing stuff struggling.
So does that mean the fancy tech isn't always a silver bullet?
It raises that exact question. Does this amazing technology provide a consistent edge across all their business lines? Or is it perhaps more niche, maybe more exposed to industrial cycles in pharma or electronics, rather than the steady consumer demand driving flavors and fragrances? It suggests even great tech needs the right market application.
Okay. So we've seen what they do. But the real drama, that profit collapse we talked about, seems tied to where they do it. Let's look at their global footprint.
Right. Takasago is definitely global. In FY 2024, Japan was still their biggest market, about 37% of sales. Then came the Americas at nearly 26%, Asia outside Japan at just over 20%, and Europe at 17%.
Seems reasonably spread out, diversified.
On the surface, yes. But this is where that profit story gets really, really concerning. While total sales were up, the operating profit picture by region is, well, it's grim in places.
How grim?
In Japan, operating profit fell over 40%. Okay, not great, but manageable maybe. In the Americas, it collapsed, down 76.3%.
Wow, 76%.
Yeah. And Europe went from making a profit of about $800 million the year before to losing nearly $1.3 billion, a massive negative swing.
So profits basically evaporated in the West.
Pretty much. And management's commentary gives us the aha moment here. They explicitly say that if you exclude the benefit they got from the weak Japanese yen.
The currency effect.
Exactly. If you take that out, real sales in the Americas and Europe actually went down.
So the reported sales growth in those regions wasn't even real underlying growth. It was just currency making the numbers look better.
Precisely. It masked underlying weakness. It points to a significant lack of pricing power for Takasago in those Western markets. They couldn't raise prices enough to cover rising costs.
And maybe their cost structure isn't competitive there either.
That's likely part of it too. So even if volumes held up slightly due to currency making their goods cheaper, they were making less or even losing money on each sale. It's what you might call unprofitable growth hidden by Forex.
Okay, that's a crucial piece of the puzzle.
Yep.
Now let's zoom out. How does Takasago fit into the wider F&F industry? What's that landscape like?
Well, the global F&F industry is pretty interesting. It's generally considered a large defensive sector.
Defensive meaning?
Meaning it holds up relatively well even when the economy slows down because, people still need to buy food, drinks, soap, cleaning supplies, the basics.
Right, non-discretionary stuff.
Exactly. The market's estimated size is somewhere in the $30–35 billion range currently, and it's expected to grow steadily, maybe 4 or 5% per year, so it's a solid, if not explosive, industry.
And where's the growth coming from mostly?
Asia Pacific, consistently flagged as both the biggest and fastest growing region, driven by rising incomes, urbanization, growing middle class, all those big macro trends.
Which is good news for Takasago, given their strength there.
Definitely. Their strong position in Asia is a key advantage, aligning them perfectly with where the industry's momentum is.
What about broader trends shaping the whole industry? What are the big shifts happening?
Oh, there are several big ones. Probably the most dominant is the massive consumer push towards natural and clean label products.
We hear that everywhere. People reading labels more.
Absolutely. Consumers want natural, organic, simple ingredients. They're avoiding stuff that sounds artificial or chemical. This forces manufacturers to reformulate even iconic products.
But aren't synthetics still dominant?
Yes, synthetics still make up the bulk, maybe 70%, because they're often cheaper, more stable, easier to scale. But the growth is definitely in the natural segment. It's growing much faster.
Okay, what else?
Sustainability. It's moved from being a nice-to-have to basically table stakes. ESG, environmental, social, governance, it's critical now.
So ethical sourcing, carbon footprint.
All of it. Supply chain transparency, fair labor. Big clients demand this now. You won't win major contracts without a strong ESG story. It's a prerequisite for doing business at scale.
Makes sense. Any other big trends?
Yeah. The third one is health and wellness integration. It's not just about taste and smell anymore. There's growing demand for functional benefits.
Like what?
Think mood-boosting fragrances or flavors that mask the sometimes unpleasant taste of plant-based proteins in vegan foods, or flavors that allow you to drastically cut sugar or salt without ruining the taste.
Ah, like healthy indulgence or masking off notes.
Exactly. It's about combining sensory appeal with tangible health or wellness benefits. That's a big area for innovation.
So lots of opportunity driven by these trends. But it can't all be smooth sailing. What are the big headwinds, the challenges?
The biggest one consistently is raw material and supply chain volatility. This is a huge headache for the industry.
Especially for those natural ingredients everyone wants now.
Precisely. Naturals are super vulnerable to climate change droughts, floods, crop failures, diseases, even geopolitical instability disrupting supply routes.
We saw that recently, didn't we? Like cocoa prices going crazy.
Exactly. Cocoa prices soared early this year. Gum acacia, used in lots of foods and drinks, faced shortages due to conflict in Sudan. Patchouli oil, key for perfumes, was scarce because of plant disease in Indonesia.
Real-world impacts.
Absolutely. And it creates this paradox. The trend towards naturals increases the industry's exposure to its biggest risk. Companies that can manage this volatility maybe through biotech alternatives or really sophisticated, diversified supply chains gain a huge advantage.
Okay, raw material risk, what else?
The complex regulatory environment, it's a minefield. Different rules in the EU, the US, Asia, constantly changing standards for safety, labeling what chemicals are allowed.
Must be expensive to keep up with.
Very. It adds cost, slows down innovation. You might develop a great new fragrance, but then find a key ingredient is restricted in Europe, so you have to reformulate just for that market. It's complex and costly.
So Takasago is operating in this dynamic, growing, but also really challenging environment. How do they actually stack up against the really big players, the giants?
Yeah, this is where Takasago's situation gets really stark. The F&F industry is incredibly consolidated at the top. You've got the big four.
Right, who are they again?
Givaudan, dsm-firmenich. That's a merger of two giants international flavors and fragrances, usually called IFF, and Symrise.
And they dominate.
Massively. Together, they control well over half the global market. Some estimates push it towards 75%, even 80%. It's huge concentration.
And Takasago, while big, isn't in that league.
No. They're a solid top 10 player globally, which is significant, don't get me wrong. Their revenue is around $1.3 billion. But compare that to the big four, they're in the $5 billion to $13 billion range.
That's a huge difference in scale.
It's a completely different order of magnitude.
So what does that mean competitively? Takasago has strengths, right? We talked about their tech, the Nobel connection.
Absolutely. They have genuine strengths. Deep tech expertise in things like asymmetric synthesis, chiral technology, that's hard to copy, gives them an edge in high-value aroma ingredients, fine chemicals, plus their strong base in Japan and growing Asia. Those are real assets.
But the weakness is just size.
Fundamentally, yes. The analysis points squarely at a lack of scale as their primary weakness compared to the big four.
And how does that lack of scale hurt them, practically speaking?
Well, several ways. First, lower purchasing power. When buying raw materials, they just can't command the same volume discounts as a Givaudan, who buys enormous quantities globally. So their input costs are likely higher.
Okay, that makes sense.
What else? A smaller global footprint for manufacturing and R&D. They have fewer facilities spread across the world. This means they have less capacity to absorb fixed costs running those expensive labs and factories across their revenue base.
So each dollar of sales has to cover more overhead.
Essentially, yes. It makes them much more vulnerable to margin pressure when costs go up. If raw materials spike or labor costs rise, it hits their bottom line harder and faster because they have less scale to dilute those costs.
And we saw that play out dramatically in FY 2024.
Exactly. Those results are a textbook example of how lack of scale can lead to severe margin compression when inflation hits. It's a direct consequence of their size disadvantage.
So let's put some numbers on this profitability gap. How bad is it compared to the big four?
It's quite stark. If you look at EBITDA margins, that's a common measure of operational profitability. The big four are consistently in the mid-teens to low 20% range.
Like
Givaudan's around 21%, dsm-firmenich 14-15%, IFF around 17%, Symrise maybe 19%. Healthy margins for this kind of industry.
and Takasago in FY 2024.
Their equivalent EBITDA margin was only around 5.2%. And their operating margin, as we said, plunged to just 1.2%.
Wow, that's a massive difference, not even close.
It's a chasm. And it's not just a number, it reflects a fundamental structural disadvantage. The big guys manage costs better through global purchasing. They leverage huge networks for R&D and production efficiency. They have more pricing power with big global clients who want global suppliers.
So Takasago is kind of stuck. Less efficient, less pricing power.
It makes it incredibly tough. Their underperformance financially is a clear reflection of this weaker competitive position. It really underscores the massive challenge they're facing.
Okay, so they're up against these giants. They have a scale problem, and it hammered their profits last year. But they're not standing still.
Right.
What's this big turnaround plan they've launched?
Right. Let's just quickly recap those FY 2024 numbers because they really set the stage for everything that followed. Record sales, $195.9 billion, up almost 5%.
Star.
But operating profit crashed 61.1% to just $2.3 billion. Net income down 63.5% to $2.7 billion. And that operating margin squeezed from 3.2% down to a wafer-thin 1.2%.
A collapse, really.
Undeniably. And management was pretty blunt about why. They pointed to higher SG&A, cost-selling, general, admin, including labor, but critically, they highlighted their inability to pass on rising raw material costs through price increases.
That lack of pricing power we just talked about.
Exactly. It bit them hard. They got squeezed between rising costs and customers unwilling or unable to accept higher prices from them, likely because bigger competitors could offer better deals or absorb the costs themselves.
So the crisis forced their hand. What's the plan?
It's called the New Global Plan 2, or NGP2. It's their 3-year roadmap running from FY 2024 through FY 2026. It's designed to be the core of their turnaround.
And what are the main goals?
Big goals. Expand growth overseas, sure, but crucially radically improve profitability, especially back home in Japan.
Okay, sounds good. What are the targets?
They are incredibly ambitious. By FY 2026, they're aiming for $220 billion in sales. Okay, that's steady growth. But the operating profit target, $11 billion.
$11 billion, up from just $2.3 billion in FY 24.
Yeah. That's nearly a 5-fold increase in just 2 years.
Wow.
Very aggressive.
That seems extremely challenging.
It is. They're also targeting an operating margin of 5.0%, getting back to healthier levels, and a return on equity between 4% and 8%.
So they're not just aiming for recovery, they're aiming for a transformation. How are they planning to achieve that?
With massive investment. The plan calls for spending $57 billion over the 3 years.
$57 billion. How does that compare to before?
It's more than double the investment of the previous 3-year plan, which was around $27 billion. It's a huge step up in capital expenditure.
Where's that money go?
A significant chunk is earmarked for R&D and production capacity. A prime example is they recently announced buying land in Kamakura to build a brand new state-of-the-art research facility.
Doubling down on innovation, playing to their strengths.
That seems to be the strategy. A big bet that investing heavily in R&D, leveraging that scientific expertise, will generate new, higher-margin products and processes that can command better prices and differentiate them more strongly.
Okay, massive investment. Anything else in the plan?
Yes, interestingly, alongside this huge spending plan, they also introduced a new shareholder return policy. They're targeting a dividend payout ratio of 30% or more, and also setting a minimum dividend based on equity.
Wait, so they're dramatically increasing investment and promising more cash back to shareholders, all while profits have just collapsed.
Exactly. And this is where the analysis calls it a clear double-edged sword. It's a very high-risk, high-reward gamble.
How so?
Well, it signals enormous confidence from management that the $557 billion investment will pay off, that it will drive the innovation and efficiency needed to hit that massive profit recovery target.
They're betting the farm, essentially.
Pretty much. If they succeed, you could see huge margin expansion, a big jump in profits, and the market could significantly re-rate the stock upwards. A classic turnaround success.
But the flip side,
If they fail to hit those ambitious targets, or if the investments don't generate the expected returns quickly enough, pouring all that money out while increasing dividends with currently weak profits and cash flow, well, it could put serious strain on their balance sheet. It could backfire badly.
so it really is make or break.
Yeah.
A high-stakes play to escape their current situation. Can they pull it off? What are the biggest hurdles?
Well, looking at leadership, the president and CEO is Satoshi Masumura. And it's worth noting, as the analysis points out, that while they did grow sales under the previous plan, they missed the profitability targets. That struggle became undeniable last year.
So the track record on hitting profit goals isn't perfect?
No, which adds to the execution risks this time around. But interestingly, there was an external push too.
What do you mean?
The analysis mentions that this whole NGP2 plan was actually formulated partly in response to a request from the Tokyo Stock Exchange. The TSE has been pushing listed companies generally to be more focused on shareholder value, cost of capital, stock price.
So pressure from the market itself to get their house in order.
It seems like it. A push for better governance, more transparency, and a clear plan to deliver value, which, combined with their internal strengths, like having Dr. Nuyori, the Nobel laureate, still on the board reinforcing that science culture, they have pieces in place.
But plans and potential are one thing. What are the concrete risks they face in trying to execute this?
The number one risk, without a doubt, is execution risk. Can they actually do it? Achieving that nearly 5-fold jump in operating profit in just 2 years is formidable.
Depends on a lot of things going right.
Totally. Successful R&D leading to hit products, real efficiency gains across the board, and crucially, finding that pricing power they lacked before. It's a very tall order.
What else?
Raw material volatility, that hasn't gone away. If costs spike again and they still can't pass them on, or if their R&D doesn't find ways around the volatile ingredients, then the margin recovery plan gets derailed. Same problem as before.
And the big competitors aren't going anywhere.
Exactly. Competitive pressure is constant. The scale advantage of the Big Four remains. They'll keep fighting for market share, leveraging their size. Takasago is always going to be somewhat punching above their weight against them.
Then there's currency risk, Ro. They want more overseas sales.
Yep. Foreign exchange risk. If the yen strengthens significantly against the dollar or euro, it'll hurt their reported overseas results when translated back. That's largely out of their control, but can have a big impact. They're targeting 66% of sales overseas, so that exposure is significant.
And finally, regulations.
Regulatory risk. Always lurking in this industry. A ban on a key ingredient, new environmental rules, stricter labeling. It can force costly reformulations, disrupt supply chains, and delay innovation. It's a constant operational drag.
Okay, so a lot of hurdles.
Mm-hmm.
Given all the struggles, the ambition, the risk, and what does the market think?
Huh?
How is Takasago valued right now?
Well, as of mid-2025, the stock was trading at a trailing PE ratio, price to earnings, of around 10 to 13 times.
How does that compare historically for them?
It's actually at the lower end of their historical range. They've been much higher, sometimes over 25x when things were going well, but also lower, maybe down to 6x during tough times. So 10, 13x is cautious.
And compared to the big four competitors.
It's a significant discount. Those larger peers typically trade at much higher premium valuations, often in the 20s, 30s, or even higher PE multiples.
So what does that discount tell us?
It strongly suggests the market is skeptical. It's pricing in considerable doubt about whether Takasago can actually achieve that massive profit recovery laid out in NGP2. If investors truly believed they'd hit $11 billion in operating profit by FY26, the valuation would almost certainly be higher.
So the market is basically saying, we don't believe the targets.
That seems to be the implication. The critical driver for Takasago's valuation going forward is their operating margin. Can they get it back up to that 5% target or even close? The current stock price seems to reflect a belief that they probably won't, or at least there's a very high risk they won't.
Okay, so we've gone really deep here into their history, the recent shock, the bold plan, the risks. What's the final takeaway for our listeners? #outro.
Well, summing it all up, Takasago is truly at a strategic crossroads. It's a pivotal moment for the company.
Let's frame the bull case first. What's the argument for them?
Okay, the bull case. You've got a company with a strong foothold in the fastest growing region, Asia Pacific. They possess genuine world-class technology, especially in niche areas, underscored by that Nobel Prize connection.
And they have a plan.
Yes, they have NGP2. A clear, albeit incredibly ambitious plan with massive R&D investment aimed squarely at leveraging those tech strengths to create higher margin products. And it's a big if they execute, you could see a dramatic profit recovery and a significant jump in the stock's valuation. It's a potential turnaround play.
Okay, now the bear case. The reasons for caution.
The bear case starts with that brutal FY 2024 performance. The margin collapse highlighted persistent weaknesses, lack of pricing power, a potential cost structure disadvantage against bigger rivals, and that unprofitable growth in the West.
The scale issue.
The scale issue looms large. And the NGP2 plan itself carries huge risk. Pouring money into investments while promising higher dividends could strain the balance sheet badly if the turnaround stalls. Plus, they remain vulnerable to those external shocks, raw materials, currency that they've struggled with before.
So the core question for you, the listener, really boils down to this. Is that current discounted valuation justified skepticism? Or is it an opportunity created by excessive pessimism?
Exactly. It all hinges on your confidence, your belief in management's ability to actually hit those incredibly ambitious 2026 profit targets against some pretty stiff headwinds.
And stepping back from the investment angle for a second, Takasago's story really highlights a universal business challenge, doesn't it?
Absolutely. How does an established company, even one with unique strengths, innovate and thrive when it's constantly battling larger, more powerful competitors in a market that's changing really fast?
It's a question relevant way beyond just flavors and fragrances. Almost every sector faces this dynamic. So maybe a final thought for everyone listening. If you were running Takasago right now, facing this situation, what would you prioritize? How would you balance that need for breakthrough innovation with the urgent need for profitability?
Yeah, what would be your first move? Something to think about maybe next time you notice the scent of your laundry detergent or the taste of your favorite snack. There's often a complex story and high stakes hidden right there.
We hope you enjoyed this deep dive into Takasago International. Join us next time as we unpack another fascinating subject.